AI stocks are crashing. Is the bubble finally bursting? Then July hit. And everything changed. Here's exactly what happened, with the real numbers. July 1, 2026. Meta Platforms announced something called Meta Compute, their own internal AI computing system. This might sound boring, but think about what it means. If Meta builds its own chips and computing power, they don't need to buy as many chips from Nvidia, Intel, and AMD. One announcement, and the entire chip sector started shaking. July 2, 2026. The Philadelphia Semiconductor Index, remember, the one that was up 65% just weeks before, fell 6.7% in a single day. That's its biggest single-day loss since the post-COVID crash. CoreWeave fell 13.9% in one day. Nebius Group fell 17% in one day. But it got worse. Micron Technology, the trillion-dollar company, fell 13% in a single session, erasing $138 billion in market value. One day. Gone. Intel fell 21% over just 7 trading days. Not one day, 7 days of straight bleeding. AMD dropped 7 to 8%. SanDisk, Marvell, Analog Devices, Western Digital, Texas Instruments, Qualcomm, all fell around 9% each. And Nvidia, the king of AI chips, lost approximately $1 trillion in market value in less than 2 months, falling 18% from its peak. To put that in perspective, $1 trillion is more than the entire annual economic output of the Netherlands, Saudi Arabia, or Switzerland. The crash wasn't just in America. South Korea's stock market, which has Samsung and SK Hynix, two of the biggest chipmakers in the world, fell so hard that the exchange had to automatically pause trading to prevent a complete collapse. The Kospi index fell nearly 10% in a single day. Samsung fell 9%. SK Hynix fell 15%. Together, just those two companies lost $290 billion in a single day. And here's the most insane part, Samsung reported record profits during this time. Their quarterly operating profit was up over 1,800% year-over-year. 1,800%. And their stock still fell. That tells you everything you need to know about what's actually happening here. So the big question, why? Why did all of this happen? There are 3 reasons. And they're all connected. Reason number 1, the dot-com déjà vu problem. Go back to the year 2000. The internet was new. Everyone said it would change the world. And they were right, but investors got so excited that they put billions of dollars into internet companies that had 0 revenue, 0 profit, and sometimes 0 actual products. When reality hit, the Nasdaq fell 78% from its peak. Trillions of dollars vanished. Now fast forward to 2026. AI is real, AI is powerful, and AI will change the world. Nobody's arguing that. But investors have been pouring money into AI companies and AI chip companies at a pace that might not match the actual returns. One analyst at Wedbush said, "This is the 3rd inning in a 9-inning game, meaning we're still early." But the stock prices were already priced like we were in the 9th inning winning by 10 runs. The specific example that scared everyone, Nvidia's revenue is growing at 85% per year. That's incredible. But Nvidia's stock price had already priced in that growth and more. When investors started asking, okay, but what's the actual business model for all this AI spending? There wasn't a clean answer. No major generative AI company has proven a clear path to massive profitability yet. Reason number 2, Intel's manufacturing problem. Intel had a plan called 18A, their most advanced chip manufacturing technology, designed to compete directly with TSMC, which is the Taiwanese company that makes the most advanced chips in the world. Intel's stock had already risen 278% in the first half of 2026 based largely on hopes for this technology. Then reports came out that Intel's 18A process would not reach profitable production until late 2026 or even 2027, much later than expected. The bull thesis for Intel's comeback? Gone. The stock fell 21% in 7 days. Reason number 3, the Fed's hawkish stance. This connects back to our last video about interest rates. New Fed Chairman Kevin Warsh has been signaling that rate hikes are possible. Higher interest rates are particularly painful for high-growth tech stocks like AI companies. Here's why: when interest rates are low, investors are willing to pay a high price today for profits that are expected to come in 5 or 10 years from now. But when rates go up, money today becomes more valuable, which means those future profits are worth less in today's dollars. So rising rates directly compress the valuations of growth stocks. 9 of 18 Fed policymakers are now supporting higher rates this year. That's a dramatic shift from just a few months ago when not a single policymaker was forecasting any hikes. Now let's talk about what this actually means for you, because most of you watching this don't own AI stocks directly. So why does this matter? First, if you have money in index funds or ETFs, you're more exposed to this than you think. The S&P 500 has massive concentration in tech. Nvidia alone at its peak was one of the top 5 largest companies in the entire index. When Nvidia falls 18%, it drags the whole index down. So even if you're just investing in a basic S&P 500 index fund through your Robinhood or your 401k, you felt this. Second, this sell-off changes the hiring market. When AI companies and chip companies are losing value, they cut budgets. They slow down hiring. They lay people off. We've already seen early-stage AI startups shutting down across Silicon Valley. If you're planning to work in tech or AI, the job market in the next 6 to 12 months could be more competitive than it's been in years. Third, and this is actually good news for some of you, if you've been wanting to invest in AI companies but felt like you missed the boat, this sell-off might be creating the opportunity you've been waiting for. Let's talk about the key question everyone is asking: is this a bubble bursting, or is this a healthy correction? Here's what the data shows. The bull case: Nvidia's revenue is still growing at 85% per year. Q2 2026 semiconductor industry earnings are projected to grow 131% year-over-year according to FactSet. The big cloud companies are still spending hundreds of billions on AI infrastructure. This spending hasn't stopped. And TSMC, which makes chips for basically everyone, just reported strong earnings in July 2026, suggesting actual demand is still there. Analyst Dan Ives wrote that we're in the 3rd inning of a 9-inning game, plenty of runway left. The bear case: the Philadelphia Semiconductor Index has now shed more than 20% from its June peak. Micron is down 17% from its high of $1,213. Intel is down 21%. OpenAI has reportedly delayed its IPO to 2027 to protect its $1 trillion valuation, which signals even the biggest AI company in the world is being cautious right now. And so far, no major generative AI product has proven a clear path to massive consumer revenue. My honest take? This looks more like a mid-cycle reset than a full bubble burst. The technology is real, the demand is real, and the earnings are real. But prices had gotten ahead of reality. The market is now asking for proof that all this AI spending actually generates returns. The companies that can show that proof will likely recover strongly. The ones that can't will keep falling. So what should you actually do right now? If you already own AI or chip stocks and you're down, don't panic sell. Panic selling locks in your losses. The worst thing you can do in a correction is sell at the bottom. If your thesis for buying was, AI is the future, nothing about this sell-off changes that thesis. What changed is the price, not the technology. If you don't own any AI stocks and you want to get in, this might be your entry point. Nvidia at $193 is a very different conversation than Nvidia at $240. But don't go all in at once. Use a strategy called dollar cost averaging. Invest a fixed amount every week or every month, regardless of the price. This way you're not trying to time the bottom perfectly, which nobody can do. If you're not ready to pick individual stocks, look at semiconductor ETFs like SMH or SOXX. These give you exposure to the entire chip sector, so you're not betting everything on one company. Even after the sell-off, SMH was still up nearly 59% year-to-date at certain points, showing how strong the underlying trend still is. And if you're not sure whether to invest at all, focus on your emergency fund first. Make sure you have 3 to 6 months of expenses saved in a high-yield savings account before you put any money in the stock market. Investing with money you might need next month is how people make panic decisions. Here's the bottom line on the AI crash of July 2026. Over $1 trillion was wiped from the semiconductor sector in just a few weeks. Micron down 17%. Intel down 21%. Nvidia lost $1 trillion in market cap. South Korea's market circuit breakers fired. Samsung reported record profits and still fell. All of it triggered by one fundamental question: are we actually getting a return on all this AI spending? The answer is, probably yes, eventually. But the market ran too far, too fast, and now it's recalibrating. This is not 2000.com all over again. The technology is real and the earnings are real. But it's a reminder that even the best technology in the world can be overpriced. The people who make money in moments like this are not the ones who panic, they're the ones who understand what's happening and make calm, smart decisions while everyone else is reacting emotionally. That's what this channel is for. That's a wrap for today. If this video gave you a clearer picture of what's happening with AI stocks right now, drop a like, it helps the channel more than you know. And drop a comment below, do you think this is a buying opportunity or is the AI bubble just getting started bursting? I read every single comment and I'll personally reply. See you in the next one. Peace.